Good morning. This is Japanese Economic Review Channel. Yesterday, March 23, 2026, the global financial landscape was shaken by a historic market shock. What began as a series of geopolitical escalations over the weekend transformed into a massive domino effect on Japanese equities. Today, we look back at the data from that tumultuous session to understand the catalysts of the crash and what they signal for the days ahead. The final tallies from yesterday's session were staggering. The Nikkei 225 plummeted 1,857 points to finish at 51,515, marking its first drop into the 51,000 range in 2.5 months. The TOPIX followed suit, losing 122 points. Market breadth was nearly non-existent. 95% of the prime market, 1,515 stocks, ended the day in the red, with a massive total turnover of 7.8 trillion Japanese yen. Yesterday's collapse was triggered by a perfect storm of events between March 20th and 22. President Trump issued a 48-hour ultimatum to Iran regarding the Strait of Hormuz, sparking immediate fears of an energy shock. Compounding this, Fed Governor Waller warned that persistent high oil prices would fuel inflation, causing hopes for a U.S. interest rate cut to evaporate and sending global yields higher. The stage for yesterday's disaster was actually set last Friday in New York. The Nasdaq dropped over 440 points as rising yields crushed tech valuations just prior to the Tokyo Open. Major semiconductor players like Western Digital, Intel, and Micron suffered outsized damage. This precursor accurately forecast the heavy selling pressure that decimated Tokyo's high-tech and machinery sectors throughout yesterday's session. Yesterday's trading was defined by early panic. The Nikkei hit an intraday low of 50,688 at 10:01 a.m., a staggering 2,683-point drop from the previous close. Following this plunge, the market entered a paralyzed holding pattern for the remainder of the day. While there was a slight technical bounce from the morning lows, active buying remained heavily constrained as investors adopted a wait-and-see mood. The contagion yesterday was absolute, with all 33 TOPIX industry groups ending the day lower. This sea of red spanned from energy and shipping to rate-sensitive sectors like real estate and machinery. Even defensive sectors like construction and wholesale trade were not spared, illustrating that yesterday's sell-off was a broad-based withdrawal of capital, driven by systemic macro headwinds rather than individual company fundamentals. The TSE Growth 250 Index also suffered, breaking recent lows, as flagship names like Cover, Astroscale Holdings, and Tiny faced heavy selling. Amidst the chaos, however, there was one notable outlier. Stella Pharma moved violently against the trend to hit its daily limit up. This serves as a reminder that even in a crash, the market continues to reward companies with unique, idiosyncratic catalysts. Following yesterday's shock, we remain at a macro crossroads. The market is highly vulnerable to the intersection of Middle East volatility and the paralysis of U.S. monetary easing. While macro panic dominates headlines, it is vital to note that micro-level business activity continues. From Meiji's product launches to JR East's pioneering biodiesel initiatives and Bipergy's AI services, vigilance remains essential as we watch for the next move in the Strait of Hormuz. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.